Hello, how's everybody doing today? Let me know out there if you guys are able to hear me. I always am afraid of going through a live stream without any audio, which happened once a long time ago. A lot of things to talk about today. And to be honest with you, market reaction today has more to do with anticipation than it does actual news, in my opinion, even though there is plenty of actual news that is out there. What people are digesting right now is the possibility of what all the earnings releases this week, and because we're beginning earnings season, what all the earnings releases this week are going to say about the economy in general. So I'm happy to take any questions you might have today. I hope you guys caught my earlier video where I went through a long series of Bill Ackman tweets. And I don't normally look at Twitter at all. I haven't logged in on my Twitter account in years. It's not on my phone. But when I do log into Twitter or look at Twitter, it's usually happening kind of on a secondhand basis, meaning I see an article that piques my interest or something like that. And that's one of my fundamental problems with Twitter. So I have talked about this before on my live streams before, how I didn't think that the deal was likely to go through with Twitter. I still think it is definitely not likely to go through under the same sort of conditions that were put forth with the original tender offer. I do think that it might go through at reduced cost, which might seem like a win for Elon Musk in the long run, but there's a few things to consider here. Even in the case of successful tender offers, right, where the companies are bought out or they merge, you generally have a few lawsuits at the end of that process, right? In this case, because there's a lot of Twitter communication about this entire process, because I don't think that he's going to be able to resist communicating further on Twitter during this whole process. You're going to see a whole ream of lawsuits from shareholders that come out, not just people that are actually involved in Twitter, but you're going to see, I mean, there are armies of lawyers right now preparing lawsuits. So a couple of reasons why I've been skeptical about this deal from the very beginning. If it was really about free speech, then what price is too high? And I think a few factors, and I put all of these thoughts down on my Discord chat that you can access through my Patreon. There's a link in the description. But I think a lot of the things that went on, he didn't have a ton of control over. The most important factors he didn't really have a ton of control over. And I think that he was a little bit impulsive about his desire to buy Twitter and fix it. It certainly has flaws. My concern is, are those flaws actually fixable? And I have one giant concern when it comes to how Twitter is consumed. Is the business really monetizable? Twitter has struggled for years now to maintain profitability, and its format, especially the way you consume it on your phone, actually limits the ways you can monetize it. And the paywall idea that he floated was basically created panic and was dead as soon as it was floated, right? So who is the main audience on Twitter and who uses it? It's largely celebrities, journalists, and intellectuals of some sort who are active users of Twitter. But most people who consume Twitter do it kind of in the way I do. They do it in a secondhand manner. I don't ever log into my account. I'm only aware of tweets when they show up in some other form of media, like a newspaper article. I usually don't even go to Twitter to look at them. I'm just reading the tweets that are made in the newspaper article now, or in the online journal. Now, those pages are actually monetized, but Twitter doesn't get anything of it, meaning lots of people are using the material, using the things that are published on Twitter, and Twitter's not making a dime off of it. So additionally, having an affair with the person that he intended on appointing the CEO of Twitter and having twins with them complicates things enormously. You guys can figure that out. But the big cause here is interest rates. He has zero control over interest rates. And they made that deal somewhere between 40 and 50% more expensive to finance. And that was just over the last couple of months, especially in light of the fact that he was going to finance them by using initially by using margin, which would have cost a lot. Although I know he did sell quite a few shares, almost $8 billion in shares. But using margin, if things had gone really wrong, might have even caused him to lose a large portion of his control over Tesla if that deal went sour and he was unable to find a way to make Twitter work in the long term. So Yeah, and the fact that Twitter stock price cratered along with everything else made him seem that he was overpaying. The fact that Tesla's stock price crashed as well meant that he had to put more shares up in terms of collateral. But I think the main point there, the two main points here are really point 3 and point 4, which is how Twitter is consumed and the cost of the deal going forward. So, because most people don't have a Twitter account, they're like me; they consume it secondhand. And popular Twitter users probably have a seriously distorted view of how much reach Twitter actually has that they can monetize because of this. Now, what comes next is that mountain of lawsuits against Elon Musk for stock manipulation. He's going to settle out of court, but it's going to cost him in terms of time, drawing his focus away from Tesla, and it's going to cost a lot of money. He's basically destroyed the value of Twitter at this point and probably cost, they've had hiring freezes, people have left the company, and he's cost hundreds of thousands of Twitter stockholders serious cash. They're going to be pissed. There's going to be an army of lawyers out there right now preparing to launch dozens of suits against him. A few suits always happen, even in the case of successful tender offers. And my question is what do you think is going to happen now? Like, he's inevitably going to make this worse by tweeting things about the case while it's ongoing. His ego is really just too large for this not to be a possibility and a likelihood. So, yeah. So let me know what you guys think about the Twitter deal. I think it's this point it's just a massive, massive distraction. I think he should settle as quickly as possible and either acquire the company at reduced cost or walk away from the deal entirely. So material adverse effects, that's what he's alleging right now, that he's suffering because of what's going on in with Twitter, with them not providing him the data that he needs to make an assessment. I don't know that that's actually true. I don't know that it's actually just an excuse. But once a deal is signed, the likelihood that you can actually prevail in a case involving a material adverse effect is really, really slim. Like in the last 20 years, I think I can remember maybe 2 cases where that happened. Maybe 2 cases out of hundreds and hundreds of mergers and tender offers like this. So it's going to be a long legal road from this point forward. And I see it as a distraction from his core businesses of Tesla and of SpaceX and other things that he could be concentrating on. So yeah. Bram says the fact that I ended up with 2 Twitter accounts without even knowing says a lot, right? Interesting that you have 2 Twitter accounts. Like I've had one, but I probably haven't logged into it in like 5 years. It's just an enormous distraction. Just like Facebook was, I eventually got off Facebook, not because I didn't enjoy the format, just because it took up enormous amounts of time and I was super mean to people on it. So I don't really use it anymore. In terms of social media, I just use it for advertising my various businesses at this point. So look, markets today were down across the board. The Dow Jones is down about 0.5%, S&P about 1.1%, NASDAQ 100 down about 2%. So really tech kind of took the brunt of that. And small caps were just down a little bit too, 2.1%. Most of that is really just fear of what comes next in terms of company earnings. So I hope you guys had a chance to watch the video that I made earlier on the sort of Twitter thread that Bill Ackman had, talking about his theory about, or really hypothesis about what's going on right now in terms of markets and the economy. And it presents an alternative point of view to the one that I have, that we're already in a recession. After reading that thread, I'm actually not really convinced that we are in a recession. And really what that comes down to is the difference between real GDP growth and nominal GDP growth. And what the Federal Reserve and what other economic think tanks are evaluating is actually real economic growth once inflation is factored in. So the point that he makes in that thread is that we don't have a demand problem. Demand for goods and demand for services is still high and it's growing. What we have is a supply problem. We can't get everything we need in a manner that satisfies the time to market requirements that that worldwide consumers are expecting. So how long does it take to iron out? You have to get people to commit to producing. And I know a lot of people are saying, hey, this could serve to localize supply chains and things like that. I would say that that assessment is a little bit naive, and largely because I have run many experiments right now trying to acquire things from my various businesses locally and have failed to get suppliers to really commit to investing in what they need in order to supply my company what I need, largely because they know that as supply chains normalize, the price pressure to order things from Pakistan or India or China is going to be enormous, right? The price difference between what it can be manufactured here in the United States and in the Western world and how it can be manufactured in China, India, or Pakistan, the price pressures are just absolutely enormous. And this has happened over and over and over, where I basically begged local suppliers, hey, help me out here. Make it within 20% of the cost of sending away to Pakistan to get something or China to get something, and I'd be happy to buy from you. And a lot of times they can't do that. So this is one of the reasons why you're seeing underinvestment in production capacity here in the United States. They know that eventually, as markets normalize, pricing pressures are going to be pretty enormous. So, like I said at the beginning of the live stream, if you guys have any questions about what's going on in markets right now, this graph right here has remained relatively unchanged since the beginning of the year. Almost no asset classes are up for the year other than energy. Energy at this point, I think, is about 29%, 29% growth of the year. That represents 67% compound annual growth. But I think we see the direction that oil prices are heading at this point. I don't know if that's simply demand destruction. I think it has a lot to do with futures trading. And we have a huge amount of futures that are expiring at the end of August, and I expect a pretty significant price drop after that. So, so let me know what you guys are thinking out there in the comments. Otherwise, I'm just going to address some of the headlines right now, and let's take a look a little bit at CNBC. This is not something that I pull up. Dominating the news here is that home buyers are canceling deals at the highest rate since the beginning of the pandemic. And that probably has a lot to do with affordability and people just not understanding how much less affordable a $500,000 home was 3 months ago, 4 months ago in comparison to today. It's basically you're spending about $500 more per $100,000 per month on a place now because of the rise in interest rates. So Americans are canceling deals to buy homes at the highest rates since the start of the COVID pandemic. The share of sale agreements on existing homes canceled in June was just under 15% of all homes that went into contract. That's the highest share since early 2020 when home buying paused immediately, albeit briefly. Cancellations were about 11% 1 year ago. So a slight tick up. Actually, if you do the math, it's not really all that slight. It's basically a 30% tick up in cancellations. So higher mortgage rates and surging inflation are causing many potential home buyers to reconsider their purchases. Average rate on the 30-year fixed mortgage started this year around 3%, rising steadily. It shot briefly above 6% in mid-June before settling into a narrow range of about 5.75%. Higher mortgage rates have also caused some borrowers to no longer qualify for the loans they want. Lenders generally used a front-end debt-to-income ratio of about 28% as the ceiling for home loans. The cost of owning a median price home in the second quarter required 31.5% of average U.S. wages, according to a report by Adam, a property data provider. That's the highest percentage since 2007 and up from 24% the year before, making it the biggest jump in more than 2 decades. Buyers are also seeing this once red-hot market turn around quickly and dramatically. They may no longer see the urgency in bidding for a home that they might feel will depreciate in the coming year. The slowdown, and this spells not terrible news for the housing market, but definitely not great news for the housing market, which is a bellwether for the rest of the economy here. Okay. Home builders are seeing higher cancellation rates. Even before the sharpest increases in June, cancellations in May jumped to 9.3% in a survey of builders by John Burns Real Estate Consulting. That compares to 6.6% in May of 2021. That's a pretty significant jump. So buyer's remorse and calculations shortly after contract are increasing. Builders state buyers are nervous about a potential recession, struggling to get comfortable with higher payments, or expecting home prices to decline. So I think some of this is just a little bit of shock right now when it comes to the general market. I think that we're going to see people get used to the higher interest rate environment at some point. And I think that we'll see home buying kind of normalize. It's been red hot for about 2 years now. It's only normal that you see a little bit of slowdown here. So, yeah. Other news here that's that's in the headlines here is Rivian is planning layoffs that could target about 5% of staff. Honestly, based on the level of production they have, I'm not sure that that's really meaningful at this point. So, Rivian is a company that I don't own stock in. It is a company that I find very interesting. I really like their product, but I don't own stock in that company. And I just think they have a real narrow pathway to success. And they're saying that they're going to lay off about 5% of its roughly 14,000 employees, and the cuts are not going to affect manufacturing. I don't know if so I've seen a few of these vehicles driving around town. I have not had the opportunity to get inside of one and check it out. But yeah, words of wisdom for newbie stock investors looking to start now. Good timing for investors. So that question is a double-edged sword, of course. The market could still decline in the future. We don't know. No expert out there actually knows what's going to happen in the future. I don't have a crystal ball. Neither does anyone else. I will say one thing, though. Investing when everyone else is fearful, and I think Warren Buffett said it best. When everyone is greedy, then it's time to be fearful. When everyone is fearful, then it's time to be greedy. Right now, we are at a point of peak fear in a lot of cases, even though the economy is probably a better shape than we think it is. People are upset about inflation. We don't have a problem with demand at this point. And really, the indicator for a terrible economy coming down the road is a decline in demand. And we're not seeing that at this point. We're at near record inflation, or 3.6% inflation. And there's always people leaving the job market. There's always people that simply refuse to be employed. And, that is, it doesn't get much better than it is right now in terms of an employment picture. And power has shifted to the labor market from employers, which means we're actually kind of in a wage and price spiral at this point. But there's also some good news that came out in terms of inflation when it comes to expectations for inflation. And I don't remember the exact numbers because I heard this on NPR that based on some surveys, the general public thinks that inflation over the next 2 to 4 years is going to abate significantly. The Federal Reserve pays attention to what people think about inflation. This is one of the numbers that they'll look at quite a bit. So on average, people thought that in 3 years, or then in 2 years, inflation would drop to 4.8%, and it would drop to 2.7% in 4 years after 4 years. So that's a good sign that people tend to have a little bit more confidence in the economy than we initially thought. But look, when it comes to evaluating the economy, we're always looking at numbers that trail what's actually going on. So the data we get and the conclusions that we make are sometimes even outdated by about a month or so. So yeah, in terms of investing for newbie stock investors, that's probably a private conversation that we should have, Nichelle, under the auspices of the company that I actually work for. Giving out specific advice via YouTube is absolutely, advice specific to you personally as an investor is absolutely not permitted. I would say that get started on the right foot with a diversified portfolio. Get used to investing in that on a regular basis by dollar cost averaging, investing a little bit every month. And after you've got that diversified portfolio kind of under your belt, then you can start looking at investing in some individual stocks. Investing in individual stocks, though, carries risk that you need to be aware of. And I'm happy to talk to anybody about that. So, yeah. So, interesting news going on right now in terms of the crypto market as well. I have desperately tried not to look at my Coinbase account for the last couple of months, but happy to talk to anyone about different crypto projects that I'm keeping up with. So this is the big thing that's coming out in the next couple of weeks, and probably the biggest indication as far as whether or not we're going to be heading towards a recession. The big banks are going to start reporting their earnings this week. Second quarter results are expected to be fine. And I read another article saying that earnings expectations are kind of pie in the sky when it comes to banks. I think we're just going to have to wait and see what the actual numbers say. Remember, remember, the point in the Bill Ackman Twitter thread that I went through before is that they are 100% long stocks that have pricing power at this point, meaning they're looking at larger companies at this point, people that can use economies of scale to negotiate better prices for goods and to keep that collapse in margin from being quite as severe as it is for a company that doesn't have pricing power. And that's an important distinction to note, is that we're seeing a swing back to value stocks at this point. And that it's been almost 20 years really since we've seen a moment where value really shined, right? Well, about 20 years. And when I say that, meaning now is the point, instead of evaluating companies on future earnings, you should really start looking at some of these large cap stocks that are beat up right now and start evaluating them based on current earnings, right? Based on current cash flows, looking at things that have lower P/E ratios. And some and financials are some of those right now that look pretty good. You know, it's pretty hard for me to look at a company like Lockheed Martin that is valued at about 1.5 times sales, right? And Lockheed Martin is a defense contractor that has a huge investment in artificial intelligence. They operate it. A lot of folks who are Palantir investors don't really understand that Palantir has a lot of competition, and every military service provider is actually making huge inroads into this business right now. And a lot of them just have more experience in landing government contracts and growing their business over time. I've never been a giant fan of Palantir just because there's so much mystique around the company, so much like urban legend around the company that it's hard to really dig at the truth and understand what their business model actually is. And but Lockheed Martin is a company that's engaged in the same space, that probably has revenues equal to Palantir in that space, and they're valued at about 1.1, I think it was 1.3 to 1.5 times sales. There's a big difference in those numbers. However, when you look at a company like Snowflake, who operates in the private sector, they're valued at close to 300 times sales or something like that, something ridiculous like that. It's a huge difference in numbers. Is the private sector that much more valuable than the government sector at this point? It could be, but does it justify the difference between those valuations? I don't think that it does. And when you look at how Palantir is valued as well, I think you're going to start to see some of the same issues with that. So going forward, I think that it's right now the opportunity is in larger cap stocks, and I really think that it's in value stocks at this point. You could see some huge opportunities. Now, if you're a particularly adventurous investor and you're have a long time horizon and you have an appetite for risk, and it's not that there's a ton of risk in that, it's just that the payoff period takes a long time. Leaps might not be a bad strategy right now. Leaps are I forget what the acronym actually stands for, but you're basically buying deep in the money calls that are going to expire, that expirations are greater than a year, right? So you're able to take advantage of long-term capital gains. So for example, like maybe you're buying calls on SoFi at 2.5 set to expire 2 years from now. What is the likelihood that SoFi is not going to be worth $2.50 2 years from now? I think that is fairly slim. There are safer companies that you could do this in Microsoft right now, buying a deep in the money call on Microsoft. I think you could buy deep in the money calls on Johnson & Johnson. You could buy deep in the money calls on 3M, and those and your time horizon is out 2 to 3 years. And I think you could find some pretty unique opportunities in that space. Once again, folks, I'm not recommending this for any individual investor. You have to do your own research, come to your own conclusions. But leaps are something that you may want to start thinking about exploiting right now, particularly if you have the available cash, you're willing to wait for a year, 2 years, 3 years, and you're willing to tie the money up for that period. It magnifies your returns over time, gives you close to 1-to-1 participation. The further out you go and the deeper in the money you call is going to give you pretty much dollar for dollar participation, a little bit less than dollar for dollar participation in the rise of the stock over time, while using less than half of the purchasing power. So I've never done a video on leaps before. I've kind of hesitated to do videos on option strategies like that just because they're really complex. They can be easily misunderstood. But there's a lot of great videos that are out there. There's a lot of great material that's out there to read on the internet. And that is something that you should seriously consider. I am buying up leaps right now, not in great numbers, because I definitely don't have as much free cash flow this time around as I did in 2020 or as I did in 2008. But definitely I'm picking up some leaps. So remember also in a high inflationary environment like this, as credit spreads start to take root and start to really show up on the balance sheets, you're going to see that the big banks are going to perform better and better and better in this time period. Typically in high inflationary environments, banks do fairly well. How long inflation lasts is anyone's guess. I kind of agree with Bill Ackman's assessment here that interest rates need to come up fairly quickly, and they need to come up to about 4% by next year in order to trigger some reduction in demand and allow supply chains to sort of catch up. So yeah. Any questions about specific stocks today? If I know anything about them, I'm happy to talk about them. If I don't, I'm happy to say I don't know anything. But yeah, so the video that I put out today, though, super important. If you haven't watched it, I think it gives you a great primer for sort of understanding what's going on right now and understanding that it's far more complex than anyone says, that anyone is talking about. So I did have some questions over the weekend about this, and I think this is pretty amazing about how Joe Biden reportedly sent 5 million barrels of oil to Europe and Asia in June, even as U.S. prices hit record highs. Here are two energy stocks that could gain the most. So you really need to keep politics out of economic analysis in a lot of cases. Oil is a global market. This oil was put up for sale at auction. Even oil that is sold to Italy or sold to China, which there was oil sold to Italy and China, and in that auction, I think there were 12 winners. It was just that U.S. companies didn't have a winning bid, so some of that went overseas. But oil being a global market, even that oil going overseas helps to increase the supply of oil that's available. I've seen all kinds of very politically oriented news saying this is the only time in history that this has happened. That is completely untrue. Every president, and I think the last 4 presidents, have all released oil from the strategic reserves. No one has built it up to overflowing level, and they've all sold it on the open market, and some of it has ended up overseas. Also, you can look back in the year like 2016, 2017. No, I think it was actually 2018, where China actually was complaining that some of the oil we sold to them was contaminated, was going to be a lot more expensive to refine. It's also not true, like I've been seeing on the other side of the political spectrum, where folks are saying that the oil that we can't refine, the oil that we take out of the ground here, that's not true either. There's a lot of political misinformation when it comes to the oil industry. We have the most capable refining facilities in the entire world. We can refine anything here. We don't refine everything here, and a lot of it has to do with cost. And there are other countries that can refine certain types of oil at a lower price than we can, and it only makes sense that we sell some of that on the open market. But you sell it on the open market anyway, and not every petroleum market is global. Like gas, for instance, like natural gas, definitely not a global market. It's highly localized. It's highly regionalized, not localized, regionalized. And the U.S. is basically a silo in that market. We stand to benefit. U.S. gas producers stand to benefit pretty enormously because of some of the things that are going on in the market right now. But so a lot of interesting things happening in the world. I would say that if you have any news about the oil market right now, it needs to be looked at through the lens of politics, meaning that you have to look at who's putting it out there. You have to look at what they could be trying to say and realize that the oil market is probably more complex than you realize. So, yeah. Musk's Twitter deal cost Tesla stock up to 15%. Why shares are still falling? I don't know if I could put a number on that. But yeah. So, let me know what you guys are thinking out there. The animator says, let me see here. Hi Jason, thanks for your effort as always. I'm buying January 24th call options. I hope those work out. Like you, I do not have a lot of money, and the U.S. New Zealand exchange rate is not favorable either. So, what are you buying January 24th call options on? What stock are you buying those, and at what price point? So I have, and I'm sure I bought these at the right time. I think I have some January 2024 call options on SoFi at 20, which I bought them super cheap, but the price has actually declined since then. And yeah, I'm worried that by then they may not be back up to 20. I'm hoping they are, but SoFi for me is a super long-term investment. And the greatest thing about Leaps is that it's a form of no recourse leverage, meaning you're not going to get a margin call on. I mean, if you're buying them with actual cash, like in a retirement account or something like that, you're not going to get a margin call on your Leaps, and your loss is limited to what you put out on the table. I think one of the things that's happening right now is people panicking over leverage, people panicking over margin, and especially the really large trading houses are making a lot of moves to hedge or reduce the leverage they have right now. And that's having a huge negative effect on the market. But yeah, so one of the ways you can participate in using that leverage where there's not any recourse against you is through Leaps. And that's something that that folks who are a little bit lower on the economic scale are able to use. And when I say the economic scale, I'm talking about like regular people and non-institutional investors, people with under $1 million to invest. This is a great tool to use leverage without going in debt. It's just a different form of leverage. But yes, go ahead and let me know what stock that was purchased on. I'd be happy to check that out for you. So markets pretty much all over the world were down today. I know a lot of people are worried about what's going on in the US, but right now markets globally are being affected, from Germany to France, Japan, Australia, India, Mexico, South Korea, Brazil, China. China, of course, I wouldn't pay too much attention to the fact that they are down 4.3% today. It is a more volatile market than US markets are, period. I mean, they just have wider swings. You're looking at developed markets being down, half a point to 3/4 of a point here. Not terribly bad today. So, Neo. So that's actually pretty interesting. So Neo basically has like the company that makes scooters, battery operated scooters in China. And I'm talking about scooters too. They make like battery operated mopeds. So my problem with Neo is is that I hadn't ever seen their products anywhere actually for sale. I haven't been to China to check them out, so I didn't know how widespread they are there. But when I went to South America earlier this year, I actually saw Neo storefronts where people were actually selling them in stores, which I thought was very neat. And I saw several of them on the streets, including a number of Rappi delivery people. Rappi is a food delivery app in South America, just like DoorDash or Uber Eats or something like that. But it's, at least in Colombia where I was, it is actually the most popular one there. And I did see a couple of electric scooters being used there, and there were a couple of other brands. So I thought that was very interesting. This is not a company that I've invested in. It's not a company that I've done a video on or anything. And to be honest, I was far more skeptical about them until I saw there is a degree of market penetration in South America. And I haven't had a chance to observe to see, if they're being used in Brazil, or I probably won't be going to Venezuela anytime soon. But I'm planning on making trips at some point to Central America, like Guatemala, to South America, like Chile and Peru. I'm a big fan of archaeology, so I like to go see archaeological sites and historical sites. And there's a lot that I just don't know that much about South America. So that's been one of my fascinations lately. But Neo in particular, I was very, very surprised. So and next is going to be Fiverr, Pins, Pinterest, Neo. I'm trying to make money on all of my sold out stocks. Yeah. The other way you can make money on that if you haven't sold out on stocks and the stocks are down is through covered calls, of course. Be very careful right now where you are pricing those covered calls. Far better to accept lower premium payments to avoid having to sell them, meaning so they don't become exercised. So, yeah, be very cautious right now when it comes to selling covered calls. I did have enough to sell a put on a close to in the money put on Tesla stock recently. I went ahead and bit the bullet. I never do any sort of like short-term trading or anything like that. And this isn't necessarily short-term trading, but I did sell a put, a cash secure put on Neo stock just this morning at 680, I think. So likely to be executed between now and expiration. Happy to own Tesla at 680. I am happy to own it at 680 and then sit on it for a long time, possibly a few years. But yeah, which means that at some point, I'm going to have to maybe look at some of the other lots that I have in Tesla and see if there's any opportunity to reduce my holdings at some point. But it needs to fit into my overall grander investment strategy and my overall allocation. But yeah, so Peloton is a company that I think may be a flash in the pan. And that is not something that I would invest in at this point. I think they had a really interesting, just because I think an idea is great and just because I think the idea is cool and interesting doesn't mean it's going to work. I found this out investing in stocks, and I found this out by starting business as well that I thought were super cool that ultimately didn't work out. And you know, I may have one of those in the future here too, in terms of a business, but we haven't determined that yet. But the bottom line I want to leave you with today in this live stream is that people are upset about inflation right now, and a little bit worried about the housing market. But other parts of the economy look actually pretty good. We're seeing a substantial shift from goods purchases to services. People are buying experiences rather than things. Now, anecdotally, this is something that I recognized when I was traveling this summer, and it was absolute chaos at airports with everyone trying to go everywhere. Not enough people to satisfy all of the demand for travel at this point. And I think that is not going to abate anytime soon as long as people still have cash. And the point that Bill Ackman made in that Twitter thread was that there's almost $2.5 trillion of excess savings that consumers have right now, which means that until that is exhausted, I don't think we see an abatement in demand at this point. So let me see here. Do you build your own cash flow models for real estate or use existing templates? I use my own cash flow model for that based on what I would like to get in terms of a cap rate. So I haven't bought a new property in several years, largely because I don't enjoy being a landlord that much, especially when things go wrong. But if I'm not making a 6% cap rate on the property, and I know some people demand a higher one. If I'm not making a 6% cap rate on the property with zero effort, and I mean zero effort, then it isn't worth it for me to own it. Nothing can take up more of your time that doesn't make you any money than a bad tenant. Nothing can. And I've had some absolute disasters of tenants. Like my properties that are local here to San Diego, I've had really good luck, but I own a couple properties that are out of state that are managed remotely, or and I do use one management company in one place just because it's so hard for me to interview candidates there. That like my demands are pretty high. Like I want it to be zero issues, zero maintenance, and I got to make at least 6% on it. In the case where I'm going to be more challenged with how much time I'm spending on that property, I would demand a higher cap rate. And if you think it's easy to get that combination, which is 6% cap rate, you know, virtually zero issues, a little bit of maintenance every year, but virtually zero issues in terms of tenants, it's actually pretty hard. It's actually pretty difficult to do that. And the issue is really the right people in the right place. It is hard to find good tenants who don't destroy your property, pay their bills on time. And in the case of certain states where landlords don't have a lot of rights in comparison to tenants, you can get screwed out of 5-6 months of rent. And if you have borrowed money against that property, you really don't have a way of recovering that. So let me see here. George says, I'm trying to build a very long-term portfolio where compound interest is my best friend. Yeah. So he says, I'm currently dollar cost averaging into mining stocks with high yield, like Vale, BHP, defense sector like General Dynamics and L3 Harris. Uh, I think growth stocks will tank further next year. Any thoughts? So I think some growth stocks are going to be doing just fine by the end of the year, right? The ones that have a real opportunity for success and a real pathway to profitability within the next 4 to 5 years. And which means, and there are a lot of companies out there that have never demonstrated that they have a pathway to profitability. And who's the solid state battery maker that I can't think of right now? I can't think of the name right now, but it's a solid state battery maker. It's QuantumScape. QuantumScape is a company that was built as a growth company when it was really a science project. They do not have a pathway to profitability before the year 2027, not even in the slightest. And I never understood how that stock could get up like $100. I think it was $120 a share when I made my first comment on them. And I said, this is just crazy. They don't even have the technology that they're claiming that they're going to have by year 2027, 2028, and to be and to be producing it in the manner that is, is scaled production. They don't have that. And they're not the only company that is out there like that. And particularly when it comes to battery stocks, I would be focusing on companies right now that are scaling production, not pie in the sky new technologies at this point. Those companies may get acquired by these companies that are actually scaling production, just like Tesla went out and purchased, I think it was Maxwell, a local company here in San Diego, for their dry electrode technology. In terms of mining stocks, there's a lot of risk in there, particularly when you're looking at copper mining and a couple of other, nickel mining. Well, not necessarily nickel, but definitely copper mining. You're taking a little bit of risk there in that respect. I think that overall, a company like Albemarle might do fairly well because of their domination in, and they do, at least as far as the U.S. company they dominate in mining and chemical production for precursor chemicals that are going to be used in making batteries. I think that's a fairly good investment. In terms of the mining sector in general, though, it's highly, highly volatile. And you're looking at building an extremely long-term portfolio where compound interest is your best friend. Honestly, that's probably not the direction I would go. So I invest in my long-term portfolio where compound interest is my best friend. I invest in some dividend growth stocks, and I mostly do that through ETFs now, because most of these companies are extremely large cap, like mega cap stocks. These are all value companies, and I don't believe that I can pick those stocks more efficiently than an ETF can. And I think that your only advantage over the market is in growth stocks. Most of it's going to be the only advantage you have really is in growth stocks and small cap stocks. And the only thing where I think that you have more chances of beating the market over time than you do in like large cap stocks. There's all information on those larger cap stocks, mega cap stocks is basically public. All information is public. The market is really, really efficient when it comes to pricing, and I just don't think you have an advantage. So I like dividend growth stocks like DGRO, DGRO, or Noble, NOBL, and you're looking at companies that have raised their dividend consistently over the last 20 years or so. It tends to slightly underperform the S&P 500 with a heck of a lot less in the way of volatility. I kind of went that direction a couple of years ago, anticipating that at some point we're going to see dividends for these companies become far more important. And that is definitely the truth if we're seeing a rise in interest rates. And we're going to see some of these companies start to raise their dividends to make them attractive investments to support their stock price. You want them to be competitive with basically mid-range with mid-range in the fixed income market, meaning the 10-year the 10-year bonds and things like that. You want them to be competitive in that space. I'm not talking about government bonds. I'm talking about corporate debt. So let me see here. I think growth may have bottomed out, so I've started to add aggressively over the past few weeks. I think growth has bottomed out, but I think some things that we classified as growth companies are not coming back. I do think if you're very careful about what you're choosing, and the companies you're choosing have a short pathway to profitability, say in the next 3 to 5 years, I think you could be very, very happy with the strategy of buying aggressively in the next few weeks. So yeah. Let me see. And I also believe China and Brazil will outperform the US market in the next 5 years. China, yes. Brazil, the jury is out. I work with a lot of Brazilians, and some of them are probably going to end up seeing this if I say anything negative about the Brazilian business practices in general. So I'm not going to say anything about that because it is a generalization. It's probably not fair when it comes to individuals. But for a variety of different reasons, and a lot of them are structural, I think that China does outperform Brazil. I don't think that Brazil can outperform the US on a sustained basis. They have too many societal issues at this point. Well, we do too. Who am I kidding? But that remains to be seen. So, in general, any thoughts on a 75-year-old CEO in an extremely small cap stock? Is this a tech stock? That would be the question to ask. I generally, when it comes to a small cap stock, a growth stock, I generally like to see folks that are really focused in the industry, not the MBA types, and folks who have an understanding of how to scale. So this CEO may have a fairly solid idea of how to scale production of something, but may not really understand the underlying technology. Oh, it's a biopharma stock. Yeah, that would be a tough judgment to make, just based on age. I don't have enough information on who that CEO is, what his background is, and how innovative he's been in the past. And typically, I don't pay as much attention as the actual CEO as most people do, other than their experience in actually scaling. And that's generally what I like to see. Doesn't matter how great your idea is. If you can't get it to market, no one's going to buy it. If the US dollar weakens and commodities boom, Brazil is set up like a coiled spring. If the US dollar weakens, there's zero evidence that the US dollar is weakening now. That's kind of the issue. It's actually strengthening against other currencies, which is not good. And I don't know if you paid any attention to the euro, but the euro, I think, is at multi-decade lows. I think it may have actually briefly dropped below $1. And the last time I looked at it, it was like $1.04, which has not happened, I think, in at least 2 decades. So, and that's the other thing, like the target weakening for the US dollar is generally somewhere between 2 and 3%. That's where the Federal Reserve wants it. They want it to decline in value against other currencies by about 2 to 3%. It helps keep US exports competitive, and it helps keep imports to the US a little bit more expensive over time, and sort of helps domestic production here. The last thing that the U.S. wants is for super rapid strengthening of the U.S. dollar. That's generally bad for our economy, and we want the U.S. dollar to weaken. So maybe you're correct in that, but what commodities is Brazil selling? I mean, what commodities is Brazil selling outside of Brazil that are going to make that true? So, and oil is one of the big ones, but we've actually seen relatively declining production for them in the last couple of years, become a lot less important than I thought it was going to be. So, if you have visited London, any advices on places to visit? So I haven't been to London in a really long time, but you know what impressed me about London is that, and I'm not apologizing for this, British food in general is fairly boring, but they have some of the best restaurants I've ever been to in the entire world. You have to get a little bit off the beaten path, but there's tons of great Indian and Pakistani food if you've never been to London. Just enormous amount. Like, you'll get really tired of your basic British meals fairly quickly, especially if you are from here in the United States. And I think you'll really enjoy the fact. So Indian food in the U.S. and Indian food in London are vastly different. Now, it's been almost 25 years since I've been to London, so I couldn't give you any current advice other than have fun, and it's going to be amazing. Yeah, and people there are, the average person on the street in London is going to be far more informed about U.S. politics and government than the average American is who goes to visit. And that's one of the humbling experiences that you have there. Your cab driver is probably going to know more about politics, and you're going to have a really deep and interesting conversation with them. And you couldn't have that with the average person on the street here. And their knowledge of U.S. geography is really good too. They have vastly different opinions than the average person on the street here in the U.S. has. So I think it's very interesting. But yeah, so back to the U.S. dollar weakening, though. That is something that, like I said, the government wants the U.S. dollar to weaken in a predictable manner. And the whole push right now that a lot of people talk about, for the U.S. dollar to not be the reserve currency, it's kind of, and the idea that yields are dropping on bonds, or yields were dropping on bonds, and that's kind of because the market has kind of turned around in fixed income. A lot of that has to do with the fact that the U.S. government has simply always paid on its debt obligations. And we make it a point to always pay on our debt obligations. The only time there was ever a conversation was during the Trump administration, where he floated the idea of renegotiating U.S. debt, largely because he just didn't know that it wasn't possible, essentially, without us defaulting, or without us having like an effective default, and how that would affect the global economy. Because he's not really, So yes. But I'm sorry, I was answering a question here verbally. Brazil equities are certainly high risk, high reward. So I may be suffering here from a little bit of like personal bias, though, in terms of my actual investments in Brazilian equities. During the whole BRIC era, the early BRIC era, say around 2006 to 2008 or so, I got burned on those. Although I remember investing in an India fund and making like 100% in 1 year. And that ended up being the down payment on one of the properties that I bought. But in terms of Brazilian equities, back in the original Brazil, Russia, India, China, where everyone thought that these are going to be the new economic powerhouses. And other than China, the rest of them just kind of didn't live up to expectations. I may have a little bit of bad taste in my mouth because of that experience. I ended up losing quite a bit of money on some Brazilian equities in that time period. So take what I have to say with a grain of salt, because on two different levels, I may be a little bit biased against investing in the Brazilian market, where on the contrary, I'm a little bit less biased investing in China for a variety of different reasons, even though I understand the risks that are there. So I do find it very interesting that a lot of these major wirehouses vacillate between calling China absolutely uninvestable and then calling it the next greatest opportunity since sliced bread. I would say that if you're going to hold Chinese stocks, it's probably a good idea to hold a variety of them in several different industries. It's definitely much more volatile. I remember those stocks are always discounted simply because they are in China and the regulatory environment is in flux. I will say a couple of things. I expected the regulatory environment to be quite a bit more draconian in a lot of ways. And a lot of what was going on last year and the year before that in terms of reorganizing the regulations around publicly traded companies, I thought it would be actually a lot more draconian. And what they're trying to do in that country is to break up siloed technology like semi-monopolies, meaning once you got on Huawei's, onto like Alibaba technology, it was hard to do business with any other sort of technology silo like Baidu or other companies that were out there that sort of have their own technology silos. And a lot of the regulations they did last year and the year before that were designed to sort of break those down. And these companies now are paying fines for anti-competitive things that they're doing right now. Now, they're small fines in terms of the overall market cap, but I think they probably mean a lot more there than they do here because of how these companies are being viewed as being smacked down. So, so very interesting differences between the two countries at this point. And I also think that China is doing a much better job than Brazil is at building international partnerships all over the world. China in particular has done a great job of exploiting the goodwill that they have in Africa, which our goodwill in Africa is always attached to, I'm talking about the Western world. Our goodwill in Africa is always comes with strings attached, comes with conditions. China, on the other hand, doesn't really require any conditions for investments that they're making in the country, other than the fact that you do business with us, we do business with you. We always require something political out of the relationships that we have, the uneven relationships that we have like that. And so China, the government is actually viewed fairly positively by many people in Africa because of their different approach. Now, I feel certain that they learned that different approach by observing our mistakes. So for Chinese stocks, is holding HK version better than OTC? So I'm not really sure the answer to that question. So I started buying like Hong Kong stocks back in the 1990s when we had to pay like a really hefty like foreign investor fee. And in terms of like actually owning the Hong Kong share, though, if the stock gets completely kicked off U.S. markets where they're not even allowed to trade over the counter, you still own your H shares. So, but here's the other issue with that makes both of these less attractive than they were before, is that Hong Kong, as it existed before, under the rules and regulations they existed before, two governments are, two systems, one country. With the imposition of the Chinese security, the mainland Chinese security laws a couple of years ago, that really isn't true anymore. Hong Kong is not a bastion of democracy and freedom like it was before. And I don't want to get in trouble with because I plan on visiting China one day. But the regulatory environment that existed in Hong Kong prior to 2020 doesn't exist anymore. So it adds an additional level of risk to owning either the Hong Kong version or OTC. Having said that, I'm still buying BYD, folks, right? Why am I buying BYD? I've been covering BYD for a couple of years now. Their product line is confusing as hell, and I wish they'd do something to clean it up or make it clear as far as what vehicles are actually being sold, which battery technologies are actually being sold, who their partners are, and that sort of thing. But I think that the BYD probably represents one of the best opportunities in China right now. A better opportunity than NIO, than XPeng, than the Li Auto. They have basically passed up Tesla in terms of domestic sales, in terms of the sort of what they define as new energy vehicle sales, which is hybrids as well as pure battery electric vehicles. They're the number one producer in the world at this point. They're more vertically integrated than any company out there, including Tesla. They've gone light on the software technology and heavy on just producing adequate vehicles and getting them out there to market. They've also penetrated much further down the economic scale. Their new Seal that is coming out, base price for that is $16,000, and it has an NEDC range of 193 miles, which means it really has a range of about 150 miles. But still, that's fine for a city commuter car. And you can charge it up to full capacity in about to 80% capacity in about 15 minutes. So it's using the Blade battery, which charges very quickly. And they're saying that this battery probably has a lifetime of about 1.2 million kilometers, which is roughly 720,000 miles. So this is on another level in terms of the convenience, reliability, and predictability of that technology. And the ability to cycle is just based on the materials. It's a lithium ferrophosphate battery. They cycle anywhere from 2,000 to 4,000 times, whereas some of the other batteries out there just don't cycle as much. So, yeah. So on a macro level, as far as I can understand, the Fed wants to fix prices by reducing demand. High energy prices convenient for them since the general public. Yes, that is true. Like high energy prices on its own will serve to blunt demand. You're going to see demand destruction from that. There are some rumblings that the current administration is going to use the Defense Production Act to limit gas prices. I have no idea how that would work. So we haven't really imposed price and wage controls ever since the early 1970s. We haven't done that, right? And I'm not sure. I would be surprised if there's actually the political will to do that. And it doesn't necessarily have the effects that you think it's going to have. And it is certainly intervention in the economy that I don't want to see. And that seems to be what everyone is demanding right now on both sides of the political aisle. Is everyone is demanding intervention in the economy. While both sides claim to be capitalist and claim to believe in capitalist markets, everyone wants this heavy-handed government intervention in markets one way or the other, meaning they want the government to do something about prices. Well, how do you do something about prices, right? How do you do something about prices that isn't intervention in the economy? So that's an answer that's something that I don't have a way to answer. So ever thought of doing TikTok? So I have wasted so much time on TikTok over the last month that it's unbelievable. And it is the most addicting thing ever. And I'm actually probably going to delete it off of my phone just because anything that gets like that and starts taking up a lot of my time, I end up deleting. But I've thought about doing TikTok. I haven't even investigated how TikTok is monetized. But yes, I've definitely thought about doing it. But it's something that I would just do, make the videos, and probably not interact that much. I prefer doing things via YouTube, even though I don't make a ton of money at this. It does drive people to the financial advisory practice, so that is great too. Is it necessary to increase unemployment from the Fed's perspective, or is an alternative way? So, I mean, there could be an alternative way, like Japan had an enormous, and this backfired on them. They had an enormous problem with inflation. I don't remember what it was, but they created this giant government program that said stop spending money and save it, and invest in Japanese government bonds. And that really backfired. They were in a deflationary environment from 1991 all the way through like 2018. And so it was a huge issue with that backfiring as well. So generally, increasing unemployment is a byproduct of making borrowing money and business expansion more expensive. So the goal is unemployment to reduce demand, but generally it's a byproduct of making things more expensive. The reality is, and you can read the Fed's minutes on this, they are in uncharted waters, just like they were in 1982. They don't know the exact way that they're going to reduce inflation. No one, and over and over and over, when we face inflationary periods, the result is, or the approach has never been one with certainty. It's been, we're going to try this, we're going to try this, we're going to try this, and let's see what works. Let's take notes, and then we're armed for the next time. So the Federal Reserve actually has some other ways they could do it. They could simply, other than increasing unemployment through raising interest rates, another way they could do that is by reimposing deposit requirements on banks. Like right now, in reality, they don't really have deposit requirements. Like in the past, you had about a 6 or 7%, I don't remember the exact number, deposit requirements for bank, meaning for every dollar they had on deposit, they could loan out about 93 cents of that, and they had to keep about 7 cents in reserve. So they kind of took those away prior to the pandemic, and then they really did away with it during the pandemic to increase liquidity. But reimposing that would just suck money out of the economy instantly. It would suck money out of the economy. Money is being sucked out of the economy right now. So government spending in the past year alone has been reduced by 20% because a lot of that pandemic spending ran off the table. In addition to that, about 110 to 120 billion dollars a month is running off the Fed's balance sheet, meaning that the principal payments for those bonds that are maturing are being paid to the Federal Reserve. They're sitting on cash right now, and that money is being sucked out of the economy as well. The big furor being made over the Build Back Better plan, or whatever part of that was passed, the $1.7 trillion spending plan. That's a $1.7 trillion spending plan spread out over 10 years. We haven't spent even 170 billion of that yet. And it actually pales in comparison to the almost, I think, $980 billion annual budget we have for the military, which pumps money into the economy as well. So there's a lot of tools that the government is using right now that are sucking money out of the economy that just aren't necessarily readily apparent to the average person out on the streets. All they see is the cost of energy, and all they see is food prices going up and things like that. And like Bill Ackman says, this is not a demand problem. People want these things. It's a supply problem. You are competing against everyone else who wants to buy these things. It's a function of how capitalism works. And yeah, it had something to do with all of the excess money that people have. But I think the blame is really on snarled production here and getting things to market. So, is Warren Buffett the real Iron Man? Honestly, man, when it comes to investing, there's nobody more disciplined than Warren Buffett. Warren Buffett. He does not give two craps about what anyone says about him in terms of investing. He doesn't even respond when people like criticize him. The David Portnoy thing is what blew me away. Where he's like, "I'm a better investor than Warren Buffett." Like, you're not going to know if you're a better investor than Warren Buffett until you can compare, 20 years of returns against what he's doing. And I think that listening to him can be difficult at times because in order to employ the strategies, it takes time and it takes discipline to do that. So I think it's very difficult to evaluate yourself against him on a short-term basis. He has proven people wrong over and over and over and over and over again when it comes to investing. So, what is the PE from BYD? Actually, I don't know that off the top of my head. So you would have to look that up. You can find that on Yahoo Finance, but I can guarantee you. Whoops. See, BYD, BYDDF, BYDDY. So one of those is an 8 share and one of those is OTC. I couldn't actually tell you which one. But yeah. So price earnings, I'm not sure that this is even up to date, but that would absolutely be ridiculous. But let's take a look at quickly some other numbers in this case here. Hold on a second. All right. Once again, yeah. So, and when it comes to TikTok, you have a 15-minute daily timer for apps like Facebook and TikTok. It's actually really effective at stopping use. That's something that I will, yeah. Oh, Eric M says, is the $700 to $800 billion budget a problem? So let me put this in perspective for you. Number one, I love technology. I love things that go boom. And I appreciate, and I worked for various military service providers for 18 years. So I'm definitely not anti-military. And in fact, almost all the adults that train in my academies are former military, right? But we spend more money on our military than the next top 10 countries combined. And what do we do with that? And that is a question you need to ask. What improvements have we made in the lives of others with all of the things that we've done outside of our country in the last 20 years? You have to ask ourselves, is it really money well spent? And I'm not just talking about the almost $1 trillion military budget, but the trillions that we spent on wars in the last 20 years as well. So, whoops. Hold on a second, guys. Didn't realize that was going to play there. Let me see here. For some reason, my data is not filling in here. There we go. Anyway, yeah, so I'm going to have to do a deeper dive on the fundamentals of BYD at some point. Do a deeper dive on the actual earnings data. But yeah, it's definitely something that has. I don't think it's actually as high as what Yahoo Finance says. But yes. Any other questions you guys have here? Because we're coming up on the hour, and this is another thing that I'm trying to limit myself to about an hour a day, just because I could spend hours on doing live streams. But I actually always lose subscribers when I do live streams, even though I enjoy them a lot. But I'm doing them for my current subscribers, the ones that really like it. So yeah, fire away with any questions. If you guys want to keep me going. If not, I do want to let you know that the super chat features are on. I did have a few donations to the GoFundMe that I talked about in my last live stream. I do want to thank whoever, because the two people that gave anonymously. So I did want to thank you if you were the one that donated to that. Like I said, that's one of my students that's going through a divorce right now. But yeah, so thanks for tuning in. I'm happy to see you guys. I got a bunch of regulars now that I'm always happy to talk to. One of these days we'll have to travel where we can do a local meet and greet, or if you guys all come to San Diego, you can hang out at my bar and have a few drinks there. Anyway, thank you very much, folks. I will see you next time.